Thanks very much, Mike. Unusually, I haven't got any slides. I nearly always do, but I thought, well, academics don't do slides and barristers don't usually do slides, so I won't do any either. But what you have got in your packs is an article that I wrote for Tax Journal just before Christmas, so before the open day, before the Westminster debate, and I'm going to base my remarks around that. The government tells us that high-quality tax policy making is vital for business. Lack of clear direction, frequent changes to the tax system, and lack of attention paid to the real impact on business can all act to create uncertainty and deter investment. That's a direct quote from the Trade and Industry Guide to UK Taxation. So what I'd like to look at is a number of aspects of whether diverted profits tax measures up to this standard. Is it needed? Will it work? And what problems could it cause? Is it needed? 30 pages of legislation and 50 pages of guidance. This is not really a simplification measure. I once put forward a proposal that all finance bills should be limited to 100 pages to be in not smaller than size 12 type and not larger than A4 paper. That didn't go anywhere. But there really is a tendency to add complexity upon complexity. Surely we should look at whether we've got enough existing weapons before we really decide we need a new one. Now, I know that the GAR wasn't really defined for this, and I'm very conscious that Judith's sitting on the front row. But surely, if we think these are abusive arrangements, and they're egregious, couldn't we have a statement along the lines of, "One step closer, Mr. Hands, and I'll blow your brains out," to warn companies that if they continue with this sort of behaviour, it will be frowned upon and attacked with every weapon available. For those who are wondering, it took me ages to find where that quote originally came from. It's from Treasure Island. Avoided PE. It sounded to me as if Mike rather wishes we could move towards a civil law system with the abus de droit. But we have got Arrowtown, whether the relevant statutory provisions construed purposively were intended to apply to the transaction viewed realistically. Haven't we got something which could attack something where in substance economic activity is being carried on in the UK? The impression I was left with after the open day, unfortunately, was that this would be too difficult and that the courts might not support it. I do feel that bringing in a new tax just in case you need it is not a good answer to that question. And if we've got economic profits not being taxed in the UK, again, we have got transfer pricing rules. Let's make those more robust if we need to. Let's give HMRC more resources if it needs them. But is it really just a too difficult problem? And if the underlying problem is a lack of HMRC resources, then, as I and many others have said, we would support those resources being made available. And in fact, Pinsent Mason's put out a press release very recently showing that we've calculated that the return on investment is about 97-1 in terms of extra resources for HMRC to compliance yield from large business. So, assuming we do need it, and assuming it's going to happen, is it going to work? There's a number of aspects, some legal and some practical. I'm not going to say very much about treaties, I don't think I dare, but I have got a couple of comments back to Philip. This is a new tax. It's not really corporation tax. It's not really a tax on profits, even though we want to tax economic profits arising in the UK. It sounds awfully like a form over substance argument, and Philip might not like to be representing the taxpayer. I'm not sure how comfortable he'd be standing up representing HMRC, arguing that, no, no, no. I know it looks like a profits tax. It's even got profits tax in the name, but no, no, no. It's not anything like corporation tax. So I think that's an unattractive form over substance argument. Everything that I've heard from Mike, from Philip, from ministers, strongly suggests that this is aimed at abusive and artificial structures. Fine, say so. At the moment, there's a lot about that in the guidance, but it doesn't say it clearly in the legislation. The view I came to in writing the article for Tax Journal, and I stand by it, is that I think it probably would be defensible against a treaty or EU law challenge, but only just. and I can think of quite a few lawyers, at least 8 of whom are in this room, who would have a go at challenging it. So I think it needs making robust to make it clear that if it is only aimed at the extremes, the egregious situations, that needs to be stated. I've got a couple of points of detail though, Philip. I mean, it's not whether something's been designed, it's whether it's reasonable to assume that it's been designed. And the trouble is, a reasonable inspector of taxes might reasonably assume that it has been designed to do that, but it might not have been. And, yes, again, perfectly reasonable to attack pure brass plate companies, but I can't help thinking that a large Irish call centre with lots of people selling advertising is a bit more than a brass plate company. So I'm not convinced the balance is right. There isn't enough emphasis on a purpose test. There's a lot more trying to define specific rules of lack of economic substance, tax mismatch rules. I think it needs to be made clearer that this is narrowly targeted. Turning to the 2 specific situations, the artificial avoidance of PE. A PE is a threshold test, and Mike took us back to some first principles. Why have we got the PE rule? It's so that when allocating the taxing rights between 2 countries, the country of source agrees that it won't tax income arising in that country unless a threshold has been reached. Well, either it's been reached or it hasn't. And I don't really see that it's artificial to require contracts to be approved in Ireland. Either there is real economic activity going on in the UK and you want that to be a PE, in which case I think I might change the definition of what you mean by a PE quite clearly in UK law, or it's not. And again, Deborah made the point about we have got OECD work going on in this area. One point that came out to me very strongly from the open day is the sort of flow-through or global policeman aspect. If HMRC think it's reasonable to assume that you have got an avoided PE, then in doing the profit attribution, they'll look at what's happening at the head office, and if that hasn't got much profit left there because it's paying a royalty out to a tax haven where there's not much substance, ignore that, lots of profit, lots of it apportioned back to the UK. So there feels to me to be quite a strong global policeman element to this. I know Mike Williams said, if you don't help yourself, you can't expect others to help you. I heard him say, help yourself in another way. This feels like the UK deciding to help ourselves to income that we'd like to tax, even though we haven't got perhaps enough confidence that we can do it at the moment. If the profit doesn't match economic substance, I still find it hard to see why transfer pricing rules don't deal with that. There was some interesting discussion at the open day, and those slides have been circulated to everybody who was there. I'm presuming, Mike, that they'll be made more generally available at some point on a website somewhere. Mike W?
I assume that they can be put on the HMRC website.
Yeah. So the interesting discussion was around what if you've got a low-risk, well-behaved group that's got an APA with full disclosure, will that protect it against diverted profits tax? Answer, maybe, but not if it's a pre-April 2015 one because it didn't take account of the law which now exists. I think we really need a way of topping up an existing APA so that this is not taking up resources of the taxpayer community or HMRC in companies which are not intended to be within scope. On a separate point, I did look back at the lecture that Mike Devereux did to the CIOT and the IFS back in October 2013. And you did say at that point, Mike, why should there be economic substance in the place where a loan is made or where intangible property is owned? I think that's the point you were making now. We seem to have got very hung up on this economic substance point. Fine in terms of trading activities, but is it really relevant to the pure passive holder of intellectual property or a loan? Turning to the calculation, there are several places where there are references to the alternative provision as it is just unreasonable to assume would have been made or imposed. Oh, that's easy, isn't it? Effectively, it's an expanded Wilberforce comparator, IRC and Parker. But this is going to ask far more questions than it will answer, and I'm going to leave it to Paul to explore just where that might lead us. Turning to other practical issues, in deciding whether this is something which is designed to avoid tax, you've got to compare the tax benefit to the economic benefit of the transaction. Now, you can measure the tax benefit, you can work out how much tax you've got to pay, but measuring the economic benefit of a transaction is not always easy. A very simple example that was given by somebody at a bank is if a customer asks to consolidate all their accounts in one overall managed account, that might take quite a lot of hassle to do for the bank. They might not make any profit from it, but they retain the goodwill of the customer. Now, how do you measure the economic benefit of doing that if it just so happens that that results in a lower tax bill? And I fully appreciate you haven't designed it, but I come back to it might be reasonable to assume that you designed it, so you're putting the burden of proof onto the business to show they didn't. The requirement to notify, and I'm encouraged that this is an area where Mike has indicated to be sympathetic to some redrafting. I'd like to draw your attention to section 13.1. There is a requirement to notify if there is a period for which it is reasonable to assume taxable diverted profits might arise to the company. Might is a pretty low threshold. What we need here is, to take the NHS analogy, we need to make sure that we've not got it being impossible to get employment with your CRM or GP, and we certainly don't want you ending up in A&E and flooding the technical specialists as well. We just need something practical so that those who are not within the intended scope don't have to do a lot of work on it. Pay now, argue later. This is like a super APN, and given that a lot of lawyers, including Pinsent Masons, think that the APNs are outrageous in some aspects, boy, we'll have a field day in challenging these. It's not quite as Philip said. Firstly, the inspector makes a preliminary notice. The 30-day charging on that is on very narrow grounds. It's only on arithmetical issues or errors of fact. It's not on the basic principle of whether the transfer pricing's right. Then you have to pay. Then you've got the 12 months review period, and then and only then you can go to the tribunal. Surely you've either got to allow access to the tribunal at the beginning, or you've got to defer the payment until the end of that review period. I think that's just going too far. But most importantly, I think there is a risk that this undermines the BEPS process. As I think Mike has already said, BEPS is fragile. If it fails, it will be really awful because we will get overlapping and inconsistent measures, inevitably leading to double or multiple taxation burdens. That's not a good outcome for business or the UK economy. And even if the UK is convinced that what they're doing is wholly complementary to BEPS, that's not how it's coming across. As Alan Greenspan, and in fact before him Richard Nixon, said, "I know you think you understand what you thought I said, but I'm not sure you realise that what you heard is not what I meant." I hope the cameras picked that one up because I'm not going to say it again. So this really needs to be put firmly within the context of the BEPS process. And I also think, despite Mike saying it's unlikely, I think we need time for government to debate it. I think a Westminster Hall debate at which there was a Treasury Minister, a Shadow Treasury Minister, a Lib Dem Treasury Minister, and rather a lot of members of the DUP, for reasons I have not yet been able to determine, is not a substitute for a debate in a Finance Bill committee. We have had these issues before. In 2005, the measures on arbitrage and similar measures were deferred into the second Finance Bill. I think if we're going to make legislation, it should be Parliament who makes it after proper debate. So in summary, I understand and sympathise with the government's wish to do something about aggressive avoidance, but bringing in complex legislation in a hurry is generally a recipe for disaster. It would be much better to consult and get it right. Above all, let's give BEPS a chance. Thank you.